Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. What a move we saw on the S&P 500 this week. We obviously had the CPI reading. We had the inflation number come out lower and colder than expected, fueling one of the largest moves we've seen on the market, I think, since 2020. Biggest single day move on the S&P 500 since 2020, and before that 2018, and before that during the 2019 rally. So is this going to be looked back upon as the turning point for the S&P 500 and the beginning of a brand new bull run? That's something we're going to cover in this video. We're going to talk about that in detail. By the way, if you are new here, don't forget to smash that subscribe button. And of course, click on that like button if you enjoyed this video. It does really help push out our videos to more people. If you find it useful, if you find it educational, it only takes a couple of seconds and it's really appreciated. So of course, the story of this week was the CPI reading right here that came in at 7.7% as opposed to the 7.98% that was expected. So clearly, visually, you can see that inflation is rolling over. Now, a lot of people are very skeptical of that. I saw a lot of experts on CNBC talking about the fact that we should see this with a lot of skepticism. So we're going to talk about that in this video and actually figure out if we should be skeptical. But now quickly looking at the technicals, we broke out of the short-term trend here. There was this trend line we were looking at for quite some time. Okay, the market here is really waiting for that CPI to come down. If CPI begins to cool down, you're going to see the market rally, right? This is the setup we were looking at for months now, really, on gameoftrades.net. You can check out our Q4 newsletter that was posted back in September in the link down below. And this was the setup, right? So we can't cry victory too soon, right? We have a downtrend line here. There's a lot of reasons to be very concerned about the market, right? We're not putting that into question, but a revisit of the 200-week moving average has often marked very important bottoms in the market, and combined with some divergence here. You can see momentum moving back higher, even making a bullish crossover here as the S&P 500 tests the 200-week moving average. This is really what you want to see. You want to see a strong rally off of that, and perhaps it would have been a completely different story had we seen a hot CPI reading, right? So this is why macro really is important if you want to capture the larger trends in the market. If inflation had continued to accelerate this month, in fact, if it continues to accelerate in the months ahead, this setup doesn't mean anything, right? It's going to get burned through and you're going to see a much larger move down. As inflation really, goes off the chart, the Fed needs to raise rates even higher, despite the fact that the economy is slowing. So a hot CPI reading perhaps would have been fuel enough to take the market lower. But evidently that's not what happened. And let me put a few very important levels here, because when you break out above a bearish price channel, what do you have to put on your price chart? Well, a bullish price channel. If you're paying attention to short-term signals on the market, which by the way is incredibly difficult to really do in a successful manner, but I'd say these are some of the significant levels we're paying attention to right now. This bullish price channel right there, capturing these lows, capturing these highs, coinciding with this 4,100 point resistance and the 3,900 point support level that was broken following the CPI release. So we're out of this short-term downtrend. If we put up the MACD on this daily chart, we have bullish momentum resuming. And so we're eyeing this zone of resistance here at 4,100 points. That's going to be an interesting battle if or when the market gets there. Now we'll also be watching intermarket signals from treasury bonds, right? This is the inverse of the 10-year yield that has been just an incredible tool to use throughout 2022. It's been on the right side of a lot of moves, on the market. And you can see here this higher high is something I like to see from the treasury bond market, confirming this higher high we're seeing, as opposed to, for example, this period here where the market was rallying higher throughout the month of August, but bonds were going in the opposite direction, right? So here we are getting a confirmation from the bond market that perhaps this rally is sustainable in the near term. Now, the corporate bond market is perhaps telling a different story. So this is something that, despite the optimism, despite the strength of the move that we saw here, this is a reason to be a little bit more skeptical here. Something we'll be closely watching and covering on gameoftrades.net, especially if we start to get closer to these resistance levels. You really want to see J and K put in that higher high, or else it's potentially the corporate bond market here invalidating that move. So we need to stay objective about that, despite the fact that we have some short-term bullish developments. Our short-term bias is bullish. Momentum is positive. The MACD is above the zero line, so we're trending higher right now. Now, of course, this is all just intermarket analysis, technical analysis, which are additional tools to give you an idea of how to take advantage of the market more tactically. That's really our investment philosophy at gameoftrades.net, is that we have a broader macro thesis that's well researched, that's well put together, and then in the near term, we use our knowledge of technical analysis, internal analysis, intermarket analysis to understand the short-term setup and make investors who want to take advantage of that macro thesis and help investors in a very actionable way to take advantage of that macro thesis. So that's why you're going to see on our website that some of the articles are labeled as tactical articles, some of them are labeled as strategic articles. That's really what the difference is. Now, we posted a full overview of the CPI reading and the market's reaction on the website today. But I do want to address the question, and I saw that in a few comments in the last video, that we should see this CPI reading with a lot of skepticism. So here, this is basically a chart making an overview of what has contributed to the lower inflation reading that we saw for the month of October. And from our observation, this is not just a one-off. You can see gasoline, food, services, they are all decelerating, and gasoline is even contracting. Right, gasoline being the leading indicator for inflation throughout 2021, it's now showing signs of actual contraction, right? Outright deflation. And we've shown many times that gasoline prices are not only the biggest contributor to CPI, but historically, it just tends to lead and be a good leading indicator of CPI. The only part of the CPI that's not contracting right now is shelter. You can see here in green, it's moving higher. But if we go back to an article where we talked about inflation and the Fed that was posted on October 19th, we posted this chart here that basically makes the case that the shelter component of the CPI is a lagging indicator, right? Yes, it continues to move higher right now, but it's pretty much guaranteed if we look at other indicators that shelter CPI is going to roll over, it's going to catch up to the downside. So the only part of the CPI that was actually moving higher this month, not decelerating, is shelter, and that's a lagging indicator. So the market is seeing through that, really not being concerned by what's happening on the shelter CPI, because we know that the housing market is slowing down significantly. So why should we be concerned about a lagging indicator of inflation? That just doesn't make sense. Now, as I said earlier, we are posting an overview of the CPI today. What sector is going to be the big beneficiary from the macro environment that we're heading into, just based off the initial market reaction, how we're positioning through the model portfolio heading into this environment. In fact, the model portfolio is going to be updated this coming Monday, and how far and how long we think this rally here could actually go before we run into some other problems that are not inflation and the Fed. Because yes, the market has been about the Fed and inflation throughout 2022, but that's not what always drives the market. There's also earnings and economic contractions, rising unemployment that can be a major headwind to the market, and that's something we need to pay attention to, and that's definitely something we need to pay attention to. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading, and see you next time.